Hi everyone, I'm Munib, co-founder of Blockstack. Blockstack is the next evolution in computing. We've seen three main eras of computing before. We had mainframes that were these large computers that everyone depended on. Then we got desktops where users were in control and they owned their own computers and their data and information. And then we saw cloud computing where we are dependent on these large companies running services for us. And we are about to embark on this major shift in computing called decentralized computing, where users are getting back in control. In this next evolution of computing, there's less reliance on large tech companies, and it enables a more direct relationship between developers and users.
I'm Patrick, and I'm the head of growth at Blockstack PBC. I'm excited about the thousands of developers that are pioneering in the Blockstack ecosystem. It's early days, but already we're seeing alternatives to Google Docs, DocuSign, TurboTax, Facebook, LastPass, Evernote, and more.
The network went live in late 2018, and we already have more than 100 applications built on Blockstack. With Blockstack, users register their own universal username that works everywhere. They don't have to create new accounts with every single application. They don't have to worry about passwords. And applications are storing data with the users. What that means is that users are in control of their own data. If you don't like an application, you can just delete it without worrying about what this application can do with my information.
I'm Brittany, and I run investor relations at Blockstack. I actually met Blockstack when I was working at Union Square Ventures in 2014. We led the seed round in the company and then went on to lead the Series A as well. So in total, Blockstack has raised over $50 million, but that's only been from institutions and accredited investors. That's why I'm so excited that now we can actually open up to the general public and share Blockstack with everyone.
The Blockstack network is not run by any single company. Instead, it is powered by the Stacks token. Stacks tokens are consumed as fuel when you register digital assets or smart contracts on the system. And if you want to execute these smart contracts, you use the Stacks tokens as well.
I'm excited about the Stacks token for how it's going to accelerate the development of applications in the Blockstack ecosystem and let us build a world that really puts users first.
At Blockstack, we care about compliance and regulations. We publicly filed with the SEC, and that offering has now been qualified. Potential investors should sign up for notifications at stackstoken.com.
Assalamu alaikum, everyone. Welcome back to our crypto webinar series hosted by Stacks Pakistan. So I'm your host, Muhammad Salman Hanif, and our guest here today is Aziz Zainuddin. So I'll begin by introducing our guest. Aziz bin Zainuddin is the Chief Product Officer at Facet, a regulated platform that aims to streamline digital asset adoption across frontier markets. Aziz spearheads end-to-end asset tokenization initiatives in Facet, working with regulators to greenfield digital asset frameworks for the industry. As a digital asset native, he has a deep passion for evangelizing blockchain technology. Prior to his role at Facet, he was founder and editor-in-chief of Master the Crypto, a popular knowledge hub and resource center that focuses on cryptocurrency investing and all things blockchain. His writings have been used and referenced by academics as well as governments of various countries in the field of blockchain technology. So Aziz, before I get to the question bit, would you like to introduce yourself to our audience?
Yes, sure. The introduction that you gave on me was succinct, but on a more greater level, as in here in Facet, what we are is basically what we want to do is to spearhead digital asset adoption, which is, I think, very similar to what Stacks is doing. So I think in that line, as in we have a shared vision, right, to ensure that every single one, everywhere globally, right, understands cryptocurrencies, understands blockchain, and makes informed decisions with regards to this new asset class.
Thank you for that. So I'm just going to delve right into it. Let's start off with the most basic thing. Can you tell me what a block is? Like when we say blockchain, so what does the block part mean? and like
Got
having
it.
these blocks come together and form a blockchain.
Got it. So when you hear the term blockchain, right, as in it's basically literally means a chain of blocks, if you can conceptually visualize it, right? And what does this blocks contain? So these blocks contain basically transactions, right? Transactions of, for example, if someone is sending Bitcoin from Pakistan, right? And
Yeah.
it's going to be received by someone in the US. So that's considered a transaction because you're sending a transaction over, right? A Bitcoin transaction. So the accumulation of transactions, all these transactions into what you call, if you can visualize like a block, right? And that's where all the transactions will be stored, right? And then it's going to be validated, and once it finalized, it will basically be the newest or the latest block containing all the final and verified transactions in the blockchain, and the blockchain keeps on getting keeps on getting longer, right? This chain of blocks keeps on getting longer with more transactions on it. So essentially blocks is basically the container that houses all the transactions that has been finalized.
So, like, let me get this straight. So, what you're saying is each block, like every time there's a new block, so that block contains all of the previous transactions and every new transaction. So, every time there's a new transaction, is there a new block, or is the block just that one new transaction and the previous transactions are the old ones? So, I just want to get that part straight.
Yeah, sure. So for us to further understand that, right? Let's assume like as in the Bitcoin blockchain started from ground zero today. Right now, as in as in there has been no blocks created.
Aziz and Salman are the first two people to use Bitcoin.
Exactly. So, for example, someone wants to send Bitcoin to Aziz, which is the first ever transaction, and assume that in this first ever transaction, there's only going to be one transaction, right? So we call the first block ever to be created in any blockchain system the Genesis block, right? Which contains basically the first ever Coinbase, right? Of the single transaction. Now, what happens is that transaction is basically stored, right? It goes through a process of encryption, or what you call hashing, right? And then that is basically timestamped and stored in that block, right? And then it gets finalized. Now, what do we mean by finalization? It means that that transaction has been verified by the rules of the decentralized system, and then it has been stored inside the blockchain. That block is confirmed and finalized because basically it checks all the tick box of being a valid transaction, right? And so that is what we call a fully verified block on the blockchain, in which that block contains the first ever verified transaction between Salman and Aziz.
Yeah. So let's say you have Mr. Munib come in now. So Mr. Munib makes another transaction with, let's say, Mr. Nabil or Ms. Mehek. So now their transaction will add another block.
Yes.
And
so
will the new block contain the transaction between Salman and Aziz, or will that be in the previous block just connected to the new block?
So you bring up a good point. One of the beauties about blockchain is that all past transactions which has been approved or finalized or validated, right, is linked to each other. And this creates what you call a single source of truth, where, for example, assume there has already been 5,000 blocks which has been verified, right? And that's the single source of truth. The next block number 5,001, right? What happens in the formation of the new block is that you get basically the ID or the digital fingerprint of the previous block, which has already been validated and verified, right? And then you paste that that ID into the new block, and then you fill that up with new transactions, right? Whatever new transactions that come in, and then you store it in that new block, which already contains the blueprint of the previous block, in which the previous block contains the blueprint of the previous block all the way into the first block. So you can see that there's a lineage, right? A connection between all blocks, right? From old blocks all the way to a new block. And this this lineage keeps it, ensures that, you can't change it. That's why you call a blockchain an immutable data record, right? Because for you to change any transaction within any blocks, you literally have to change all the data within all the blocks, which although is mathematically possible, but
it's near
not
impossible.
viable. Yeah, exactly, very near impossible to do that. You might as well use the resources and the energy to do that.
Yeah.
To mine the bitcoins, right? To secure the network and
Which is
earn
something
bitcoins.
that we'll have to get to later. Mining,
Exactly.
I think. Now let's leave it towards the end of the session. So you said that these processes are validated, right?
Yes.
So, like, who validates them? Because I don't know people like who especially go online to validate a transaction, and how does the validation process work? How do I know that how does my computer know, let's say, that it should validate this transaction?
Excellent. That's a very excellent question, because we all know that blockchain systems, one revolutionary part of a blockchain system is that they are decentralized. And what does it really mean to be decentralized? Look, if you say there's a single source of truth, which is the blockchain, how in the world does millions of people across the world agree to a single source of truth? What are the mechanics of that? So basically, it all goes down to one thing: the code, the underlying code. The underlying code that, as in, makes this whole thing work. Now, in the case of Bitcoin, right, the code is open source, meaning anyone can look at it, anyone can download it, right? So you can look at the code, right? And what happens is that there are predetermined rules surrounding the mechanism of how this whole protocol is going to work, right? So whenever anyone that wants to participate in the system, right? So, sorry, can you guys hear? Can you guys hear me? No? Yeah, I think it's fine. All right. Hello? Can you guys hear me? Someone can hear me? Okay, excellent.
Hello.
So basically, yeah.
Brother Aziz, I can't hear you. Are you there?
All right. Yes, I am. Can you hear me now? Okay. As in, Saida said that she can hear me. All right.
I can't hear you.
Okay. Testing 1, 2, 3. Go ahead. It's the internet. So let me just go ahead with the explication. So basically, the decentral, as in, there are predetermined rules with regards to a blockchain system. In the case of Bitcoin, you can see that there will be established rules. So whenever anyone in the blockchain, in the Bitcoin network, wants to, it's basically a global race. Every 10 minutes is a global race to find a solution to a math problem, to a complex math problem, right? So if you want to participate in it, what's the upside for you? As in, if you win that competition, you get Bitcoins, right? So who doesn't want to win Bitcoins, right? So what happens is all these miners get into a competition, and the competition entails them finalizing a block with fully verified transactions, and all those transactions has to go through the checklist programmatically, that it's all, there's a checklist. Okay, this transaction is valid. Why? Because it adheres to a certain standard, as in, once all the checkbox are ticked, right, they take all those valid transactions, they store it in a block, they find the magic solution, right, through the process of a very energy intensive process of hashing. And once they find that solution, the winner within 10 minutes will tell the entire network, hey, you know what, I found a solution, and because I found a solution, that my block is going to be the latest block which is validated by the protocol, and this is the new source of truth, this new block. So that is how basically, as in, the consensus mechanism works. So going further down, right? I'm sure it might be very technical for those who are new, right? But I will simplify in such a way, like, look, as in this is a very common problem previously in computing, right? How do you get a distributed? Okay, usually, for example, a computing system that we are used to is centralized, where there's a client and server. Basically, whenever you want to Google something, right, you type in the Google, right, and then Google is basically the server that has all the knowledge or all the information that you need, right? And that's what you call a client server, as in relationship, which is centralized. All right, so that is what we are used to now. In a decentralized network, as in basically everyone is basically the same, because everyone is their own server, right? So I know it's hard to imagine, but we always go back to one what you call that, one example of how, blockchain systems, there is what you call a Byzantine fault tolerance system, right? So it's very simple. So imagine a scenario where, they're in the olden days, right? The Romans, the Byzantine soldiers, right, which are the Romans, wants to attack a certain town, a place, right? And there are battalions of Roman soldiers, right? Assume there's like 10 battalions that needs a coordinated attack to basically be victorious, right, in winning over that country. Now, how, and this is the problem in distributed computing. How do we get full consensus, one decision that everyone agrees to, so that when they attack together, it will be successful? If one battalion or a few battalion does not coordinate their attacks, then they will fail, right? So the question begins: how do you achieve consensus within all these battalions, or what you call in computing system nodes, right? So that's what is revolutionary about blockchain, because even though we are decentralized, like really literally distributed, we can, through the design of the system, which has been hard-coded, get a consensus. Imagine millions of nodes over the world, but we all agree to a consensus of this block being the next validated, verified, and successful block, that all of us are in consensus that this is the next source of truth. So that's what is basically the revolutionary part, basically the hard-coded rules that has been in place.
Thank you for that clarification. I think a lot of us have been really curious about how all of this works. So that clarification was very much needed. So the next question would be, let's say, I asked this last week as well, but what if Satoshi Nakamoto tomorrow decides, okay, I'm going to alter the blockchain? Can they alter, or can he or her alter the blockchain for Bitcoin?
You see, that's another good question. That's a very, very valid question. Now, when we talk about decentralized system, as in, it means that no one has control over the system. Now, why? Why is this so? Because as I stated earlier, right? Decentralized means that everyone is equally the same. Everyone is the same, everyone has the same rights, and therefore no one has the ability to change something, right? Because it has already been hard-coded, and the proof is that the code is public, the code is open, is transparent, that anyone can look at the code and it's clear. All the lines of codes are very clear. It's open source, that's what you call it, right? Yeah. So whenever someone wants to initiate a change on the underlying code, right, then it diverts into a new protocol. That's what you call a hard fork, right? Because that is a new protocol which has been changed because the underlying source code has been changed. So, and that will create basically a fork or a diversion of a new kind of protocol, right? And that's where you can see a lot of those manifestation in, like, for example, Bitcoin Cash, Bitcoin Diamond, because essentially what they do is they just change the underlying transparent source code, and then they feed it as to their own parameters or specifications, and then it becomes a totally new blockchain, and which has its new coin.
So a leading question to that. So let's say somebody tomorrow decides, okay, they're going to go for that hard fork. What happens to the holders? For example, if I'm holding 500 Bitcoin, let's hope so. Let's hope that I make it to 500 Bitcoin. Anyway, let's say I'm holding 500 Bitcoin, and tomorrow there's a hard fork. So what happens to my holdings?
Got it. So the easiest answer is that nothing happens to your holding. In fact, you have double the amount of holdings that you had previously. But there's a caveat, right? So the best example is, for example, Bitcoin Cash, right? There was sort of like a disagreement or two camps in the community that said that, you know what, in order to scale Bitcoin, we need to change one part of the underlying code that allows for more transactions, right? So what happens is that, okay, a part of the community said, hey, you know what, for us to achieve our vision of a more scalable Bitcoin, let's change the underlying code, right? And then we call it Bitcoin Cash, right? And what happens when that fork or that hard fork happen is that any user that originally had Bitcoin, for example, in your case, 500 Bitcoin, now you have 500 Bitcoin Cash. So your original Bitcoin stays the same, but now you have a new coin, which was hard forked from the original Bitcoin blockchain called Bitcoin Cash. Now, obviously, the new coin needs to have utility. It needs to have a base, for that to be value, right? So it may not be as, the price would usually not be the same as the original Bitcoin, but there will always be a difference in value depending on a lot of factors.
So a leading question to that, I think let's take a more practical example where something like that happened and the users of a particular protocol or a cryptocurrency disagreed on which way that they should take. So I wanted to refer to the example of Ethereum and Ethereum Classic and how that hard fork occurred. So could you delve a bit more into that and tell us what happened there?
No, that is a very...
Let's say that you were a holder of Ethereum.
That's a good question. So that is a very sensitive thing, because that's really literally set the standard to where we are today as a community, right? Because at that point of time, Ethereum was relatively new. And what happened was that they created a decentralized autonomous organization, basically a company which is decentralized. Think of a company which is not owned by anybody, but owned by the community, right? Like a union, some sorts. Now, what happened was that there was a flaw in the code of that smart contract, of just that entity smart contract, that resulted in the leakage of funds, of user funds, right? So obviously, as in everyone in the community decided, okay, what do we do next? I mean, there is a clear hack. Now, following the most extreme sense of blockchain being decentralized and no one can change anything means that, you know what, this happened, we just have to take it. Investors have to take the loss, we just move on. I mean, this is the blockchain, you can't change it. Now, but there was another proposal, and this was generally agreed upon by the majority of the participants in the Ethereum network. Hey, you know what, let's reverse that. Let's reverse that hack so that we go to the previous setting. It's like hard reset, right?
Without this attack.
Exactly, without the attack. But to do that, you have to change basically the underlying code, right? So because you can't change the code just like that. To change the code, you will need to go through a hard fork. So the majority, there was a vote. The majority decided, hey, you know what? Let's just reset, right? Because we want to get back user funds so that this doesn't happen again, right? And then this new hard fork is called Ethereum, what we see today, right? The original untempered, as in blockchain, is Ethereum Classic, right? And granted, there's a much less following Ethereum Classic, but I mean, you got to respect the tenets of, hey, you know what? Blockchain is as in censorship resistance, you can't change the blockchain, and that is that, as in they didn't agree to the changing of the hard code. So I would say that for me, I'm agnostic, because at the end of the day, the community decides, and at the end of the day, as in this what you call that, I won't say this conflict, right? As in open source technology like blockchain, there's always bound to be differences of opinions, and that's where, to me, the innovation starts. there is a degree of discourse of innovation, of things like that.
So basically, I have a couple of leading questions from there.
Yeah.
So first question would be, so when the new hard fork happened, so the holders of the newly formed Ethereum, so the hackers, now they wouldn't have their hacked shares because like the way they altered the blockchain, that should have removed them from their holdings, right?
Yes, correct. Exactly.
So first question is there. Secondly, and most importantly, who gets to decide which blockchain keeps what name? So Ethereum suddenly turned from Ethereum Classic, suddenly turned to Ethereum Classic, and like Ethereum obviously remained Ethereum. So who gets to decide which fork keeps what name?
So basically, as in the majority gets the higher end of the stake, right? And they are the one that gets the choice, obviously, because they're the majority. And the majority decided, hey, you know what? The new fork is called Ethereum, and the old fork. I mean, in virtue of the essence of what the philosophy that they hold is the classic blockchain, which fits its name, right? So at the end of the day, the majority of the community is the one that decides. For example, major design decisions like this.
So majority is authority, even in cryptocurrency.
Yeah, exactly.
Well, especially in cryptocurrency.
Exactly.
But yeah, before we proceed further, I think it's important to explain to our viewers that like why the attack on Ethereum is very different from like their blockchain being hacked. If you could clarify that. So like,
okay, got it. Of course.
Their blockchain was hacked.
Yes.
Yeah. Could you explain the attack?
That's a very valid question, because that you have to bifurcate for example, you cannot say, oh, because of the attack, the blockchains are not safe. That's not the case at all, because look, as compared to Bitcoin, right? Bitcoin is a very simple programming language that has only one main functionality, which is like peer-to-peer cash, right? But Ethereum, on the other hand, is a completely different ecosystem, which allows for example, for smart contract development, automated smart contracts, basically smart contracts that live on their own, that operates as per their codes. Basically, they are self-living, right? Now, there was an issue at the smart contract level of a specific project or entity, that uses a specific kind of smart contract. But the blockchain itself is not, there was no defect on the blockchain, because let me tell you, if there was a defect in the blockchain, as in no one will be using the Ethereum blockchain now. So it must be clear that there was a problem at that specific application where there was an issue with that specific smart contract.
Thank you for that clarification. So yeah, moving on. I think it's important to discuss what mining is, and later on we'll go ahead and discuss how our users can, potentially get into that process.
Got it. So mining is basically the core, the fundamental pillar of what makes this entire thing work. Now, as I said previously, right, it's beautiful, and one revolutionary part about blockchain is that we all can agree to a single source of truth, a consensus, right? And the consensus one of the thing that allows a consensus, Bitcoin's consensus mechanism to work perfectly is mining. Because think about this, right? If you and decentralized means that anyone can join, right? I mean, if you're a farmer in Bangladesh or in Chile, you can literally just have a computer, download the Bitcoin blockchain, and start and get a equipment to mine Bitcoins, and you are part of the process. And what does it mean to mine? Basically, mine, for example, is basically lending your computing energy, right, to secure the system, right? And really, what does securing the system mean? Securing the system means that you use your computing energy or resources to provide basically to engage in the competition, of finalizing the next block, right? And when everyone does that, when there is a global competition, right, it makes this harder, because obviously when more competition means it's tougher to win the competition every 10 minutes, right? So everyone is putting all their energy, as in resources, into this. Why? Because at the end of the day, every human is the same, right? What's the incentive for us to do something like that? As in, because we pay for our electricity, right? That's not, we pay for a CPU, we pay for specialized hardware to do mining. So what's our return? I don't want to do this for free. I don't want to secure this for free, right? But the return is a very, as in, strong, as in, powerful thing, which is, if you are the winning miner, you get Bitcoin. If you solve the problem within 10 minutes, the new block created will automatically has been hard coded to send you an X amount of Bitcoin to your wallet, right? So you will essentially be rewarded for doing work on the blockchain. And by doing work, the amount of energy that you put into this work and to find a solution, right? That is basically the new created coins is based on those hard work. That's what they call it. The Bitcoin consensus model mechanism is called proof of work, because you have to prove that you do the work and then you get the reward. And this incentivization behavior essentially is what you call mining, right? Powers the entire ecosystem.
Right. So when you say we do work, what work like are the computers or the computing power that we're lending, what work are they doing basically?
Got it. So whenever for example, a block of transaction needs to so again, the question of how a block is validated and verified and successful, so that every single one agrees that there is the newest block on the chain, which is the next source of truth, right? So what happens is that, again, there are rules, and one of those rules is that for this to be the next winning block or the successful block, that there needs to be, for example, the magic number, we call them the nonce, right? Must be below a certain target, right? Based on the difficulty. So whenever someone finds the right nonce, it's basically an arbitrary number, right? If you find the right nonce, you are the winner. Now, as in, so don't be fooled. Right? Sorry? Yeah, you are literally using... Sorry?
So is it just guesswork? And
it's just basically random, as in just putting random numbers so that you find a code. And that's why you call the mining process like using brute force, because you are forcing your way by randomly generating the right nonce to see whether, okay, is this the magic number? If no, this is the magic number. If no, this is the magic number. So this is what you call the process of hashing, of just trying random numbers so that, who knows, at the end of the day, I get the right number. Now, this is what you call hashing. And now,
Aziz, I think we lost you there for a few seconds.
Hello. Yes, sir.
So could you trace back a bit to where you were 10 seconds, 10, okay. 15 seconds ago?
Yeah, sure. So basically, this work of finding that nonce, right, or the magic number, just for easier reference, right, it's a very intensive process where you use your equipment to just simply guess. Right, guess the next to see whether you get the right one. And the amount of computing power to guess that is tremendous across the entire ecosystem, right? So at end, there's around more than 3 trillion worth of hashing activity going on in the Bitcoin blockchain. So that is basically a global competition that you can see there.
So a couple of questions from there on. So you said the block decides to send an X amount of Bitcoin or whatever cryptocurrency you're mining to you. So what is that X amount, and what decides that X amount? Who decides?
You mean the nonce? You mean the nonce?
Yeah. So the mining reward that you get
Okay,
for
exactly. Okay,
your
so
work?
the mining rewards has been set at the code level since the day Bitcoin was born, right? And so what happens is that after a certain block level, right, after an X amount of block has been created. I think it's 4 or 2 years, if in aggregate, right? There will be what you call an event called Bitcoin halving. And this is one of those smart things about this protocol, right? Because Bitcoin is a fixed supply coin, right? Not like fiat currency where the government can just print as much money as they want. But Bitcoin is fixed to its core, right? So no one can increase or decrease the price. It's always going to be 21 million, right? But right now we are more than 18 million minted, so there's a few more, 3 million more. But the thing is, as time goes on, when Bitcoin halving event occurs, the amount of rewards that you get is cut into half, right? That miners get. So, and this makes sense. You know what? Because Bitcoin is, the more people that use Bitcoin, because it's fixed in supply, if demand goes up, price goes up. And that's where you can see Bitcoin's price from cents back when it first started. Now it's, the highest was what, $50,000, $60,000. So you can see that trend, right? And this makes sense, right? And once
There's a
it gets to a level,
long-term upward trend. Yeah.
exactly. But on a more fundamental basis, then the follow-up question would be, then if the rewards keep on halving, right, in the next years ahead, then what's the upside for the miners? Miners would simply just walk away, to a point where it's not enough, right? But you got to understand that usually there's two main parts of the rewards for miner. Number one is, yes, if you're the winner of the mining, what you get is the new minted Bitcoins, right? Yeah, it will be half in a matter of, as in next few years or next year or what, right? But the second form of stable fees that you get is basically mining fees. So imagine this, right? Imagine right now there's a fixed amount of transactions that can only be approved in this next 10 minutes, and demand is suddenly going up, right? How can you skip the line? I want my Bitcoin transaction to be approved now in the next 10 minutes. I don't want to wait 20 or 30 minutes. What do? I will pay a higher fee to the miner, right? So when the miner is aggregating all those verified as in pool of as in transaction, what he does is that obviously the logical thing to do is just to get first all the highest paying fees first, and then the next one comes in, and then they validate that first, and then you are first in line. So that is also the kind of genius system that the Bitcoin protocol has already accounted for.
Right. So, like on that point, so we see different chains when Bitcoin or any other currency is being transferred. You see ERC20, you see the Tron blockchain, and all of those have different charges. So, is that how you choose to pay higher or lower, or do you determine that yourself? Or what are the purposes that these different chains serve? Like, how do they impact the blockchain?
So two questions, right? Number one is the purpose of the different blockchains or the different structures of the blockchain, and secondly, the fee structure. Now I'll get to the fee structure because that's the easier one, this lowest hanging fruit. The fee structure for each blockchain is different because it depends on certain design decisions, like the consensus mechanism, the amount that a block can accommodate. Obviously, a block that can accommodate more as in more transactions, or at a lower cadence, instead of Bitcoin's 10 minutes, 10 seconds, right? Then obviously fees are much cheaper because the public would pay much lower fees, because I don't want my to pay 10 times if I want to be confirmed in this 10 seconds. I just wait 20 or 30 seconds. 30 seconds or 10 seconds doesn't matter for me. So that's why you can see in those blockchain where there's a shorter confirmation time or the block size is bigger, the fees are generally much lesser.
But isn't it all added to the same blockchain, as we previously discussed, that all transactions are just added to like one blockchain, and like that's how it processes? So if we have so many different chains, does that mean different blockchains, or does that mean they're all being added to the same blockchain but in a different way?
So sorry, that was in the context of a different blockchain system, right? So that is where a different blockchain has its own design decisions and consensus mechanism. For example, right now, the average block size or the average time a block is created in the Bitcoin blockchain is 10 minutes, right? Ethereum is 5 minutes, for example, and for example, XRP is like seconds. Yeah, Binance chain is like seconds as well, right? So you can see that they all have their different design decisions, and based on those fundamental design decisions is where you can see like the fees are cheaper on that certain blockchain. But you see, there's always a trade-off. There's always a trade-off when you talk about efficiency, security, and decentralization. Obviously, Bitcoin's 10 minutes is super long, right? But it is secure, right? But when you talk about as in blockchains with higher throughput, right, which can finalize more transactions, there will always be an opportunity cost in a sense that it will be more centralized, right? Because it might be using a delegated approach where it is more centralized in nature because only a few entities might be able to do the mining efforts. So there's always a trade-off, and that's why the purpose of talking about scalability of blockchains is figuring this out. What is the optimum level of speed versus decentralization versus security? So that is the main thing that as in the community is working towards.
So right, next point was, why don't we talk about the economics of the whole situation? So earlier on, when Bitcoin was, let's say, $60,000, you had 200 miners. I'm just giving an example. You had 200 miners mining Bitcoin, and now it's 36,000. So when it becomes less viable for the number of miners, and so there will be fewer miners mining the block, and hence won't it be easier for those? For example, earlier on the probability was 1 on 200 will solve that one block, and now it's 1 on 100. So shouldn't the reward increase as the price decreases? And shouldn't that matter?
Yeah, that's a good point. So that has already been integrated in the system, but not on the change of rewards. Rewards will always be constant. If the code says reward is 1 Bitcoin in the next 2,000 blocks, it's going to be 1 Bitcoin. It will never change. But what variable changes, right? Which will have an important dynamic in this discussion is what changes is what you call the difficulty level. When you have 200 miners doing a competition, theoretically, right, engaging in the competition, your chance to win is basically 0.5%, right? So because 1 out of 200, right? So that is your chance of being the winner. Now, when there are less miners, when it scales down to say 100, yeah, your probability increases. So this means that the difficulty in you being the winning miner it decreases, right? Because there's less miners, so it is less difficult to be the winner because basically there's less miners, right? And this makes mining easier when there are lesser miners because because that allows you to win. So this natural calibration of the protocol has already been integrated into the blockchain.
Yeah. So another question is, so we see, sorry, the azan's going on.
Yeah, I'm not sure.
So yeah. So this technology is currently built to our day and age, and as we see, technology is evolving every day and every second. So there's a lot of talk about quantum computers and their development and how they're able to solve questions and like everything, like all of our calculations much faster than even the supercomputers of our day and age. So my question would be, how does that impact the blockchain? For example, let's say you have a quantum computer come in and a government develops that and they mine all of the remaining Bitcoin with their computing speed that our computers or any other miner's computers cannot match.
That's valid.
My question, basically, to sum it up, is basically how is evolving technology going to impact the mining process.
Got it. Quantum computing has often been seen as basically one of the biggest, if not the biggest threat to blockchain or decentralized system. Because at the end of the day, the premise is this: quantum computing, in a nutshell, could break down basically the mechanisms that we see today in blockchains, right? Because like when I explained the mining process, right? When you do all the miners do the hard work, and this hard work is to find the magic number, right, of this hashing algorithm. You're doing hashing all the way using energy. What happens is that you are doing what you call brute force. You're just randomly guessing numbers so that you find the right one, right? So what happens with quantum computing is that it breaks that layer, in a sense that it is gonna basically find the answer at a rate of much faster than you. And once that happens, you break down the premise of the system, because that system is broken, right? Because it is gamed, right? And quantum computing will do that. Now, what is the solution to that, right? Obviously, this is a technological risk, because with innovation, there will always be ways for you to circumvent or to have to attack certain vectors to deem this mechanism as useless. And when that happens, it will be highly probable that the utility of blockchains will just disintegrate, because what then is the value of a protocol which isn't secure, right? Because quantum computing has disintegrated the very mechanisms that allow blockchain to work. So this is really a chicken and egg thing, right? Because at the end of the day, they might have already existed, and people they're using it to do that, but it will be very obvious if the effects of quantum computing on the blockchain networks present itself. Because when that happens, the entire fabric of blockchain will disintegrate, and the value or utility of blockchain will be lost. And that's where you see an exodus of people leaving and then the utility or the value starts to be zero, right, at the end of the day. But if you say right now, quantum computing has already started, right? You can easily, you just looking at blockchain analytics, you can easily look at, for example, the hashing rate or the difficulty or the players within the mining system, to see who are they, as in how much they're getting of the hash rate. Obviously, if a quantum computer steps in, they're just going to annihilate the entire stakeholder system, right? So you can obviously see the difference, but right now you don't see the traits of a unified single attacker that eats the entire size of the pie. So to say.
Yeah, another thing, once again in relation to quantum computing, was now earlier on we discussed how lending that much computing power to alter the entire blockchain, it'll waste too much energy and all of that, and not waste too much finance. How does quantum computing impact that?
Sorry, can you rephrase that question?
Earlier on, we discussed about how altering how basically hacking the blockchain and altering every single block would require too much energy, and it was better that this energy was rather used for mining, and that would be more profitable. So how would quantum computing impact that? Would quantum computing be used to alter or hack the blockchain?
So again, when we talk about the effects of quantum, for example, if you hypothetically own the only quantum computing in the world, right, and you enter into Bitcoin mining, right, and what happens is that people can sort of see if you have entered the race, because at the end of the day, it will be very, very shady if only one entity takes up the entire hash rate, takes up the entire Bitcoin reward supply, and then they can easily see, oh wait, something is wrong. And a problem in a risk in computing and distributed computing is the 51% attack, right? And if with the quantum computing, you can easily get 51% of the hash rate and basically manipulate the entire blockchain system. At that point, when there is consensus where there's an exploit or that someone is using a quantum computing, it is my personal opinion that everyone will look at that point and say, you know what, this is done. I mean, what's even the point of us continuing or distributing, as in lending our energy or help securing the network? Because obviously this competitor, this quantum guy, is gonna take over. So this is it. I'm leaving. You know, that's it. The value proposition is gone, right? Because the blockchain has been compromised.
Oh, thank you for that. I personally thought, because it doesn't seem that we're really far away from developing quantum
Yes.
computing, and there is development every day. So I thought that was a really important aspect to discuss in regards to the future of the blockchain. So
Yes.
on that note, so you see that there are currencies. For example, I was reading up on this currency called Nano. And
Yes.
you see how they've completely moved away from the mining process, and then they have started this thing about how they're completely clean and green. And there's a 2/3 consensus mechanism, and the currency doesn't rely on that basic blockchain mechanism. So,
Yes.
what would you have to say regarding that? So, there's no mining process. How would the survival of that sort of a currency be given such circumstances arise?
Got it. That manifested, that example, right? The example you gave is basically a representation of the innovation in the blockchain space, where there are various blockchain architecture as well as consensus mechanism in place that tries to innovate around, right? What is the main problem with Bitcoin blockchain? You know, although it's extremely safe and secure, right? You're using too much electricity. You know, it's slow. So how can we innovate? Bam! 100 different consensus mechanism happens, different as in blockchain architecture is conjured up, right? But then again, all this comes into the metric, right? Or for example, as in decentralization, speed, efficiency or throughput, and also security. Yeah, so that is always the design decision around crafting a new consensus model, or that. If I may to say, because I'm very familiar with Ethereum, right, and that is an example for the example that you asked, because obviously Ethereum is also the second biggest coin beside Bitcoin, right? So Ethereum wants to address the issue that you just raised, right? You know, Bitcoin is inefficient, uses too much energy, by saying, look, we are going to transit into what you call a new model called proof of stake. So instead of people using complex mining hardware, right, to compete amongst themselves and use a tremendous amount of energy, they say, you know what, let's come up with a new mechanism called proof of stake. Essentially, if you want to be part of the process of validating, all you have to do is stake your Ethereum into the system. So when you stake your Ethereum in the process, you will have the opportunity of, obviously, the more that you stake, the more opportunity that you get, the chances there to validate and earn more Ethereum. But one of the good part about that mechanism, the incentivization, is that in order to prevent bad actors from manipulating or compromising the system, if you do anything funny, the stake is gone. You relinquish your stake, you know, that you locked in this ecosystem. You know, if you want to do something which is against the rules or the behaviors or the etiquettes of the system, you lose your funds. So those, and you know, because of that, as in you don't have the energy as in requirement exponentially reduces down, right? And then there's no carbon footprint, as you see in Bitcoin. So those, you know, when you look across the white sea of all these coins implementing their own proof of whatever consensus mechanism or even different forms of blockchain, you know, this is where you see the design decision comes from. You know, a different way to incentivize behavior, you know, as well as being very cognizant of the effects of, for example, energy consumption, you know, those kind of things.
Right. So, as we're into the last part of this webinar, so we sort of discuss about how we can use the blockchain technology, and especially when I say blockchain technology, I mean the mining bit, for Pakistan's benefit. And let's say if I know nothing about mining and how to set it up, why should I set it up, and how will I set it up, and what benefit does it have to my country if I do set it up. So let's start off. Why should I set up like my own mining rig?
Okay, so I will start with the high-level economics of, for example, how it benefits your country. You look across the world at major countries that have done, which are very into Bitcoin mining, right? Even though it's, I would say, right, indirectly, even though it's a personal initiative, like, maybe 10 people in Pakistan out of tens of millions there are just doing mining. What benefit does it have in Pakistan society? Well, there is no obvious high level GDP kind of like, economic as in government policies effect. But on a personal level, these 10 guys, imagine, right? They are Bitcoin miners and they generate Bitcoins. They're in Pakistan. What happens? There's always a spillover effect. You earn Bitcoins. What do? You sell those Bitcoins and your wealth increases and you pass spillover effect within the economy around you, your family and friends, your community, and slowly you are alleviating the kind of wealth disproportion. Right now, imagine if 1 million people does that in Pakistan. You can see that the spillover effect is much stronger. Right, suddenly 1 million people own Bitcoin because they do mining, right? And then 1 million people are richer, and then the economy scales up because that million people needs to spend money and they need to liquidate their crypto. So on a high level, this is the kind of the minor economic as in interactions or dependencies that you see. Now, when you talk about
no, continue. Please continue.
Yes. So talking about how you want to do it, right? Now, you are someone who just heard about Bitcoin. This is all ultra complex. What's the first step? What should I do? Now, obviously, as a new person, it is not recommended because for you to buy your own equipment to mine, to download the entire Bitcoin blockchain, or how do I even do that, right? So there's a lot of in complexities of what you can do is just tap onto the community like Stacks and they will gladly help you, right? You have to have a reference, right? But what if you say, you know what? I just want to mine. Why? I want to earn money, but at the same time, I'm very fascinated, right? What you can do is just join mining pools, right? And mining pools are basically what they do is they accumulate everyone's energy, as in energy potential, and they mine as though it is a single unit that mines the entire
So
operation.
they basically combine your computing power.
Exactly. And then the rewards are shared equally, right? Based on, of course, your stake or
According
things
to
like
the
that.
computing power.
Exactly. That's a much easier way, right? Because you don't have to have your own mining equipment. You just rest on the infrastructure that has already been built or established, right? So there are various pools, that globally. I don't know whether there's one in Pakistan, but globally, that I'm pretty sure miners in Pakistan, it will be a good initiative for them to offer the mining pools facility
I don't.
so that anyone can.
So basically, I don't think there is any country restriction on mining pools. You can join them from
exactly.
wherever you are.
Exactly.
So why don't you just name the few mainstream ones that are being used across the globe?
I think Genesis Block is something which is one of those market leaders in that in the mining pooling cloud mining, that's what you call it, process. But bear in mind, like, there are a lot of in this regard vectors of scams or risk, right? So this is something that you have to do a lot of due diligence on, because you don't want to put your funds into a very obscure mining pool which is not recognized or is not known, right? And then those are, and there's a lot of scams going on for that, right? So although that is one way, as in this is really as in me just offering an
Aziz,
option.
just to clarify, I think you're referring to cloud mining. So you're right.
Yeah.
Are you referring to cloud mining?
Yeah,
No,
or
I
mining
was
pools.
referring.
Mining pools, right?
Yes, but my question would be, how can you join a mining pool? Like, if I have, like, let's say I have set up a mining rig, how do I use my mining rig to join a pool? Or which pool should I join if I own a mining rig?
Okay, so if you already own your mining rig, means you already have that requisite level of expertise, or even you're a computer engineer or computer scientist, right? So what you can do is basically just Google. I'm not familiar with any of those pills because I don't personally mine them. as in, but engineers in Facet, they do mine them, as in, and they're also based in Pakistan, as in coincidentally, so they could lend a helping hand in understanding more about how you guys can enter pools. But in general, in a very high level, what you can do is, any global mining pool, you would lend those energy, as in resources that you have, into the mining pool, and then you would, as in, of course, the typical standard of setting up an account, and then locking your, as in, contributing to the pool, and then at the end of the day, reward distribution is really scheduled within the contractual agreement between you and the mining pool, stuff like that, and then of course the disbursement of those.
I guess like for users there, for our viewers, there are basically both platforms available now. If you just have money and you don't have space or any technical expertise, you can just purchase cloud computing power through
Exactly,
cloud mining. And if you do have a bit of technical expertise, or you know someone who has technical expertise to build you a mining rig, so what you can do then is you can lend your computing power to a platform such, I think a few mainstream ones are Awesome Miner, Nice Hash, different platforms. Yeah, so like you can just look them up online and see their credibility.
Yes.
That is given the legality of mining. So yeah, disclaimer. So lastly, and what I wanted to conclude on is basically how profitable is mining still. So Bitcoin is not at the price that it was a couple of months ago. So how is mining still profitable, and if so, how much?
All right, so this depends on a lot of factors, especially where you are. But of course, the general factors of the price of Bitcoin, the difficulty level, those are constant, as in economic considerations that you have to assess. Now, going deeper, as in into that, is basically your energy consumption, your energy cost, right? So you have to look at your own country basis, whether electricity is cheap or not, or even if you pay for the electricity, because some people, they use their work's electricity to mine Bitcoin, right? So understanding the economics of how much energy you consume, at what price or watts, kilowatts that you buy the electricity from. And also you have to be, if you are the one that set the mining rate, you have to also be cognizant of the cooling cost, because these machines, because they perform all this hashing configurations every second for 24/7, right? Obviously, heat is one of those main things that is a byproduct of the mining process, and you have to cool them down. And that's why you can see mining pool, as in configurations in countries which are extremely cold, under a mountain, for example, or even under the sea, because naturally those are cold places. So if you really talk about the economics of how much it will be profitable, for me, I would say, look at all those considerations. If the energy consumption plus the cooling cost, everything is cheap for example, in Pakistan, which I would assume so, then obviously the trade-off would be high, right? Because at the end of the day, you may not even choose to spend your Bitcoin now. Any Bitcoin that you hold or get from mining, you don't liquidate, wait for it to go 60 or even 100K, and that is basically you storing that potential earnings, not accounting it at like a liquidation basis, for example, today.
So adding on to that, I do think that there are platforms that do that calculation for you. For example,
of course.
for people who have their own mining rigs, there are platforms that will allow you to plug in the charges that you pay for electricity and your computing power, and they calculate that profitability for you. And for those of you who are actually paying for cloud mining, your a good network will have the capability to shut itself down when it no longer remains profitable. So, as you you agree with that?
Yeah, I'm pretty sure you're more conversant in that. And definitely, there are like calculators where you can just input, for example, how much energy you're paying, the price, the cost, and then they will compute the economic viability of that. There's a lot of platforms that do that, and always when we talk about entering the crypto space or even doing mining, right? The number one thing that you have to do is you have to be an avid analyst to ensure that you make informed decisions based on your due diligence. So keep on Googling, keep on finding, as in people who understands this and ask from them, have a reference point, join communities like Stacks or Facet to understand about cryptocurrencies, and then build your structure of due diligence so that you can make better informed decisions.
Right. I think with that, the time for our session has come to an end. Aziz, it's been an absolute pleasure talking to you this week, and I hope we can have you back in a few of our future sessions to guide our viewers about, tell them more about cryptocurrency and the blockchain technology, because so complex. I don't think we've been able to cover all of it in detail.
Yes.
And as it progresses, I think we'd like to delve more into detail. So I guess that's it for this week. Thank you everyone for joining us. See you all next Thursday, inshallah. Assalamu alaikum.
Inshallah. Assalam.